Hello, chart watchers, and welcome to this Monday, August 5th, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Well, it is the start of a new week, and the selling from the end of last week is accelerating. Dow Jones Industrial Average currently down 599 points, the S&P 500 down 68, the NASDAQ down 237, and the Russell 2000 down another 39 points. You can see going back the last 2 months now, testing that early June low. 10-year Treasury yield continues dropping. It is down another 10 basis points today, 1.76%. Volatility index, as you would expect with all the selling, escalating, accelerating, and 22 was was a high that we saw back in May. I'm watching this level. If it continues to accelerate into the close, you really want to be careful in the short term in the market. Utilities moving up today, really ever since last week when we saw the selling kick in here on the Dow and the S&P 500. You can see utilities performing quite well. Real estate, same thing on a relative basis. Materials getting hit a little bit, as you can see today, but on a relative basis, doing much better. And staples, the same thing. You can look at these percentages and see that the losses today in these three sectors much less than what we're seeing in the overall market. So it's not that they're doing well, they're just doing relatively well or comparably well. Technology getting hit the hardest today, down about 3.4%. Many areas struggling within technology, communication services, consumer discretionary, and so forth. Worst area today in terms of industry groups is the renewable energy space. Huge move to the downside, but keep in mind, this has been a huge winner in 2019. So with all the selling, I think we're seeing some profit taking in some of those high growth areas within renewable energy. Internet stocks continuing to tumble since the big move up with Google's earnings just a little over a week ago. We have been consistently moving lower, and we are now testing a 1-month low on the internet group and computer hardware. After Apple's earnings, we got the big gap up, and we have seen nothing but selling there over the past few days. Finally, transportation services having another rough day. This is a group that got up close to 220 about 2 weeks ago, has lost almost 10% in just these past 10 days to 2 weeks. All right, Erin, well, it is time for another Fed-induced and U.S.-China trade tension sell-off. How are you doing?
I'm doing pretty good. I think that's pretty interesting. And I think our poll question going into, asking about whether the trade wars are going to be ending by the end of 2020. I'll be interested to get everybody's opinion because I certainly have one, but I'm going to wait until the end of the show for mine. But yeah, I was looking for a selling initiation about midweek last week. I didn't realize we were going to get this kind of selling, but I don't know. We might be starting to get really stretched out here.
Yeah, we are, but the problem is that volatility index rising. Unless we see that turn, anytime that VIX is moving like that, the selling, you can be off by 1 or 2 days in calling a bottom, and you can get absolutely crushed because, well, you can see today. I mean, the S&P 500, down close to 2.75% or something at this point. Dow down 600. All you have to do is be off by a day or two and miss one huge gap down, and all of a sudden you think you're not trading on an emotional basis, and then you have no choice.
Right.
That, to me, that's what the high VIX means. It's an emotional market. I don't like to trade. I don't really even like to be involved when the VIX is like this, so I keep my stops in play. And if I get taken out, I get taken out. But I'd rather sit in cash and wait for things to calm down than to ride this thing, this missile, wherever it's going. And that's what it's been here the last few days, literally ever since the Fed statement, came out last Wednesday. It's been selling and just won't stop.
Yeah, it's pretty crazy right now. So I don't know. I think we're getting stretched out, but calling a bottom right now. I'm not going to be catching that falling knife, as they say.
Stock market is not happy with our current Fed chief. I mean, if you go back and you look at the last 3 big selling episodes, it was right after the July 19th policy statement that came out, where Powell said, hey, we're going to continue to raise rates. They raised at that meeting, even though yields had been coming down the bond market. Everybody was pouring into treasuries. The Fed came out and said, we don't really see any problems. We're going to go ahead and raise, and we're going to keep raising in 2019. Of course, they changed their tune there. And then April 30th, May 1st came out, the same thing. They said inflation, that it was transitory, that it was just a very temporary thing, and then came out a month later and said, wow, inflation's really worse than we thought, or deflation is worse than we thought, or disinflation, heading lower in terms of inflation levels. And now here we go again. This is round 3. I'm actually tired of hearing from them, to be honest.
I can understand why when you see what happens in the market.
He's
All
3
right,
for 3.
upcoming schedule, though. I'm very excited to say that my dad will be here on Wednesday, Carl Swenlin. John Murphy will be the very next day. And then next week, we have Dr. Alexander Elder. He's one of the guys I definitely have been reading lots about and love him. He's just great. And then, of course, Julius. He's going to join us as well next week. So should be a great couple shows. Today, Monday setups. It is Monday, and I will be giving you a sentiment report as well. 10 and 10, our first symbol will be Yeti Holdings. So stay tuned for all of that. Let's go ahead and get it started, though, with technical news and headlines.
All right, sounds good. We've got some economic news out today and a little mixed. We had the July PMI services come in a little ahead of expectations, and then we had a miss on the July ISM non-manufacturing services index. And when we take a look at the 10-year Treasury yield, and just a subliminal message for our Fed chief here, but you can see the huge move down. This started, we were sideways consolidating on the 10-year Treasury yield for a couple of weeks heading into that Fed announcement. And since then, I think the bond market's being rather clear in what it is expecting from the Fed as we go forward. We were at 2.02 or 2.03% when that FOMC statement came out, and now we are sitting at 1.77%. That is, in just about any market, that is a tumble in a very, very short period of time. So we'll see how things go there. But in the meantime, let's take a look at some of the earnings that came out this morning. You can see a number of reports that came in better than expected. Tyson's actually matched. And I'll tell you that the Tyson's report, or the Tyson's chart, looks pretty good. This is in the income portfolio that I've been tracking. So it's one of the 10 stocks that I've included in there. And when you look at the chart, it's really rebounding strongly here, but it won't be in the next quarter's income portfolio because it only matched earnings expectations. I only stick with companies that beat on the top and bottom line. So there will be a change in those portfolios coming August 19th. So this will stay in until August 19th, but it is actually doing a pretty good job of lifting the income portfolio, or at least limiting the losses. Tyson's, you can see, up 9% today. They did beat on their top line. They missed on their bottom line. And I think they had some pretty encouraging things to say. But market certainly reacting very nicely here to the earnings on Tyson's Foods. All right, other earnings that came out. Figure we should mention Lind. It might help if I actually get the right symbol in here. But another pretty good reaction on this stock as we go forward. This is LIN. They had been in a downtrend, but it did hold on to price support right around 187.5, 188, and is bouncing back up today. Volume was pretty heavy, so even though we're getting the reaction, my guess is that probably somewhere between the current level and that declining 20-day moving average, it's probably going to find a top and move back down to test that 185, 186 area. Would not be surprised at all. Lowe's, and now this is a different Lowe's. This isn't the home improvement store. This is not a company that competes with Home Depot. Lowe's, though, Lowe's came out with its earnings and did beat on the bottom line. But overall, market not really impressed with the report. You can take a look and see that on a relative basis, it's actually in a really strong area of the market. But on a relative basis, it is down near a 52-week low. So the market's telling you it's not the place to be. And the reaction today, even with decent earnings, also confirming that it is not the place you want to be. So we want to be careful there. One last thing I wanted to point out here is that if we look back at a long-term chart, and I know, you go through these last 3 or 4 days, and it's been a rough period. We've obviously seen a lot of selling since the Fed meeting with the Trump tweets and all that's going on with the trade war. But I really think it's important to take a look at these bottoms, and all of these bottoms coincided with elevated VIX readings, volatility index. So when we get the VIX going, we tend to put in a pretty important bottom. We're nowhere near yet challenging what I think is a major trend line. So I'd be a little careful jumping the gun here and thinking, oh, we're heading into a bear market. I said the same thing back in May. I said the same thing back in the fourth quarter of last year. We got to let this play out. We got to let the panic go. Let these prices fall on these companies to where they need to fall to. But once the bottom is in, I think we're going to see a resumption of the bull market. I could be wrong, but that's my story, and I'm going to stick to it right now. As far as the scooters, taking a look at the scooters today, here it is, Hecla Mining right here. See the chart there, that little mini chart trying to break out above $2? I thought this was an interesting chart to look at today because the scooter is now broken back to a high that it hasn't seen. It's up around 50, and this is its highest level in about 5 months. It also has been in a downtrend, so this is not a long-term play on the long side, at least not for me. But it did have major resistance around $2. That's where it broke down on heavy volume in May, has come back up on heavy volume and failed to get through. Today's volume is heavy. Can we break through on a closing basis? Because if we can, the stock relative to its peers and the S&P 500, you can see both at about 3-month highs. So I do think short term, this one looks good, especially if we get that close above $2. For that reason, it's my scooter mover of the day.
All right, let's go ahead and look at look at an upgrade and a downgrade for you. I'm just going to pull up the page where I find this information on briefing.com. Baidu is the one we're going to look at. It has been moved from a hold to a buy. I really don't like the chart, but we'll go ahead and look at that. And McKesson has been moved from an outperform to a peer perform. So it's moved in sort of a neutral category there. But let's go ahead and look at those charts. And here is Baidu to begin with. Of course, it's been in a very long-term decline. We got the long-term sell signal all the way back here in August of last year. And ever since then, it's just been not having a good day. I think just about every day has not been a good day here. So I want to go ahead and I'm going to get the horizontal line here. And I want to show you, there's the gap. That was where it started, right back up here. And of course, we gapped way down. Now, right now, the support level, we just fell through. We got this upgrade. We've fallen through that support level that, let's see how old it is. Let's go all the way back. Well, back here, we saw it tested it back in June of 2015 is when it tested a low that low, if you want to say, there's the low back there, and you can see we're right on it. PMO has just had a sell signal well below the 0 line, not liking this one at all, but they've moved it to a buy. I don't know, I guess there's nowhere to go but up at this point. So let's go back just a little bit further. Yeah, that's about it. It's at its low for, really its all-time low is about ready to be hit. The other one, McKesson, real quick here. And this one, remember, was downgraded. But I kind of like this chart, to be honest. I'm going to get my trend line here. What I liked seeing is, look at the way that the on-balance volume has been moving since the beginning of the year. I'm going to stretch this back out just a little bit here. We now have a buy signal coming in on the PMO. So I think that is a good sign. Let's go ahead and we'll draw a little bit of we'll do a rising bottoms trend line here. And we can see that it's been looking pretty good. And if I just drag, let's see if I can do that. Okay, so I'm going to draw one more here. It's not quite in a rising trend channel, I would say. Well, yeah, now I would be looking at this as more of a wedge. So I guess I could see that as an issue here with the downgrade. Maybe we'll see that drop out of that wedge. But for now, I'm not really seeing a lot of damage here. But remember, they did move it to a neutral. And there's that support level that we've had. So I could certainly see it falling back down to test that support. But really that PMO is looking pretty good, and the OBV has been rising nicely with price. So I still kind of like it. So the upgrade Baidu, I'm not really a fan of, but the downgrade McKesson I am, and that is your upgrades and downgrades. All right. It is going to be time now to move into Monday setups. Are you all ready for that, Tom?
I am ready.
I wasn't here, so that's why I'm sort of tell me how we all did. Well, you guys did, I should say.
All right. Well, I'll go ahead and just go over these. You can see that Julius had JP Morgan at 116. I went with Dollar General at 136. And taking a look at the chart, of course, one problem is, of course, we were doing these Monday setups on Monday, which was 2 days before the Fed. And so I got to give Julius a little bit of an out here, because once the Fed had their say, we saw those 10-year Treasury yields drop, and that is not good generally for banks. And you can see that since that time last week, I think Julius's pick, JPM, was holding up quite well, but there's not a whole lot you can do when you get an announcement like that. The expectation, I think, was everyone was looking for a quarter point drop in the Fed funds rate, and then was expecting the Fed to say, hey, we'll monitor and lower if we need to. And they did. They chose not to do that. And a lot of money poured into Treasury, sending the yields lower, and that really hurt JP Morgan and a lot of the banks. So turned out to be not such a great pick, but again, I think if you keep a stop, you could have limited the damage there. On Dollar General, for mine, again, hurt by the overall market, but hey, that's part of the game. I mean, it's not just your individual stocks, but if the market sells off hard, it's really difficult to avoid the carnage. DG held up pretty well. I think it was 136 and change. It's 132, which is down maybe 3% since last Monday. But given what the market's done, I think that the relative strength here on DG has been very strong. And you can see here, DG relative to the specialty retailers is actually breaking out to a 52-week high. And relative to the S&P, since that Fed announcement, it's actually outperformed the S&P 500. So it's done well on a relative basis. I owned Dollar General, and I got stopped out when it closed back below the 50-day moving average. So I'm just on the sidelines. But overall, given the market environment, I think this one didn't perform too bad. Yeah. But now it is time, and we've got to come up with something with everything going on, Erin. What do you got?
I think I did. I'll go ahead and share what I came up with. It was a little bit more difficult this week because I am with you. I'm not really looking to open any new positions right now. So I was really kind of just floating around with a bunch of different scans, and ended up coming up with these 5. And Southern Company I do own, but I think it still looks really good. So I'm going to that's actually going to be my pick, but let's go ahead and look at the other ones. All right, Cinemark Holdings, CNK. And it's been on a pretty good run since the end of June. And what I know, it's down 3.8%, but honestly, I think that's what makes it kind of an exciting trade. 50 has just crossed above that 200-day EMA. So we're back into a bull market configuration. 20 had already crossed that 50. And the PMO is still rising, and it is not in what I would call overbought territory. This is in consumer discretionary recreational. So while it's not a space that I'm really excited about, I think going into the rest of the summer, we could see that move back up. I think we did end up with a lot of profit taking here today, and I'm looking for it to turn back up here. So that is one of them that I was looking at. Gold. I've been a fan of gold, but right now I think it's looking especially good, as if we are going to continue lower in the market. And I think even if we're not, I think gold is still looking really good right now. I'm actually going to pull up my gold chart here so you can see the one that I have in my live chart list, which you can get to from the top of the Decision Point blog. And all of these charts are available for you to look at in that chart list. And here we go. That was August 2nd on the gold contract, but we already know it broke out. It's breaking out today. There's that PMO turning up. It's not quite given us that buy signal yet, but the scooter is still really high here. And one of the things I've been noticing is, the dollar has been rising, and I think there's, certainly the possibility we continue to see that. And consequently, the correlation is pretty much upside down from what it normally is. So dollar doing well can also mean that gold will do well. And I still like gold. So that was on my list on my Monday setups. Let's look at the other two and then the one I actually did pick. Merck and Company was one that I was looking at. It's in healthcare, which is a somewhat defensive area. Again, we're seeing a big decline today, but I think that is a positive thing overall, especially since I got that PMO buy signal. So liking Merck. WP Carey Company. This one's in real estate and REITs. And again, this is sort of a defensive area. If you're thinking the market's going to continue lower, this could be a spot to go take a look. At this point, we tested that 50-day EMA. We do have the sell signal here, but I think the reason I looked at it was on my ChartWise Women scale here. And as you can see, it's just now coming back above that pink line chandelier exit and just about above that 50-day EMA. Currently, it has traded above that. And typically, when you get those breaks to the upside from the 50 over both the pink and blue lines here, you're going to see the price rise. But Southern Company is my pick this week. And there you go in my regular chart style. Again, I like seeing these pullbacks, and this is pulling back right to that support level. You can see the PMO has just given us a buy signal. I liked seeing that PMO starting to unwind, even though price didn't really get hurt that much. It didn't get damaged. And look at OBV volume. It just continues to rise nicely with that move. And of course, Southern Company is a utility, so I suspect it should do well for a little while here, at least until the market gets its feet finds the earth, I guess, to stand on. What did you come up with, Tom?
Yeah, I think utility is probably smart right now. If I had to invest, if I had to take new positions with the market doing what it's doing, it probably would have to be something that's either defensive or that is showing a lot of relative strength or is at a major support level. It's got to be something like that. It's got to be very compelling to put new money to work in a market that's literally just free falling. I mean, that's what happens when the volatility goes a little crazy here. So I'm going to go with a couple of stocks. Well, one in particular, the one I'm going to go with this week is going to be eHealth. This is the only stock that I own. Actually, no, I have two stocks that I own in my trading account. EHTH I still own with a stop on a close below the 20-day. So this was a huge earnings report, one of the best of earnings season. Stock was up to 112, is pulled back, went all the way as low as 95 today, which was pretty amazing, that kind of a pullback. But if you look at the candles, you really don't see much in the way of filled candles, meaning there's not a lot of selling during the day. I think that there is accumulation taking place. And if you can't see it from the chart, I think you will see it from the relative strength. EHTH versus the life insurance group is absolutely exploding on a relative basis. That just tells you that if the yields start to turn back to the upside, that usually favors life insurance companies. And if that were to happen, you've got a very big leader in EHTH. So obviously, if we're very fearful and money continues to pour into treasuries and the yield keeps dropping, that could be problematic. But that's why the stop's in play. EHTH relative to the S&P is really holding up well, considering it's been such a high flyer stock that's gone up from $30 8, 9, 10 months ago up to 112 just a week or two ago. I think that this pullback is very well contained. And like I said, on a relative basis, it's holding up. So if the market does turn back to the upside, I suspect a stock like EHTH will perform really well coming out of that bottom. All right, other stocks that I also like, Teradyne. I really was torn between both of these because Teradyne also had an unbelievably strong earnings report. You can see the stock went from 48 to 58. It gapped up and continued moving up throughout the day on very heavy volume. That's a great sign of demand, in my opinion. When you gap up, market makers are on the other side of the trade. They provide the liquidity, and that's why you see a lot of gap fills. In this case, market makers were on the short side of the trade, and they were on the wrong side of the trade, which doesn't happen very often. It's a good indication that there's a lot of demand out there when you get the gap up and continue going up all day long on this kind of volume, which is really unprecedented in the last year. But No stock is immune, and this is in the semiconductor space, and we know what happens to the semiconductors when the trade wars begin to escalate. So that's the reason why I didn't go with it today. But I think the fact that it's pulled back, hit its 20-day, I wrote about this one. This was the one I put in my blog as my Monday setup this week. I think there are 4 key areas of support. Top of gap support, the 20-day moving average, this double top that we broke out above, which would be about 49.50, and then finally the bottom of gap support, which is a little above 48. You can always use that 50-day moving average as a stop, but this is an accumulation zone. With semiconductors going down, of course, Teradyne's going to go down, but look at its relative strength, breaking out to new highs versus the semis. I think that's a bullish sign, and if the semis start to bounce back, I think Teradyne will be one of the first that traders look to. So I like that one as well. ENPH, for many of the same reasons. It's in a strong area, the renewable energy space. Of course, renewable energy is getting hit, so end phase is pulling back. Top of gap support, though, right around $26. We got as low as $26.11 today, and the buyers came back in, currently at $26.96. Look at the volume coming in on this gap up. I suspect 26 is going to hold. Doesn't always hold. It's not a guarantee, and especially in a market like this, got to make sure you keep your stops in play, but I do like end phase energy. I think once the dust settles, this one rallies back strongly. Lululemon, you look at it and say, well, it's back below the 50-day, volume starting to pick up. What could you possibly like here? Well, number one, it's one of the best stocks in the clothing and accessories area, even though the group has not been very good. This has been a very strong stock within the group. And I think the other thing is with earnings, this is where we gapped up from. Here was your earnings report, gapped up to 182, but we gapped from about 171, got as high as 195, and now we're back down in the low 170s. I think, again, I'm not a big fan of initiating new positions, but if I'm going to do it, I think Lululemon's getting close to a really key area. If it fails to hold 170, 171, then I would maybe look to that May low down closer to 160, which is why I'd keep a stop in play. For me, the biggest risk is the gap downs. Like we saw today, the Dow Jones opens down 380 points. It's hard to use a stop when you're constantly seeing these gaps that are clearing and moving below your stop. And so that's one of the risks of investing in a market like this on the long side. So if I was going to get in, I would probably do it with lesser shares just to try to minimize that risk to some degree. If you're right and the market comes roaring back, you don't need a lot of shares to make money. And I think you just need to use that mindset when you're approaching the stock market right now. Booz Allen, BAH, another one that's been a great performer. Look at the volume trends. I think this pullback is pretty well contained given what's taken place. And you can see relative to the S&P and relative to its peers, it remains a very strong stock. Lots of volume, lots of accumulation. This is one I'd keep an eye on. My setup from 2 weeks ago, APPS, Digital Turbine. This is turning out to be one of the best software stocks out there right now. It continues to perform well. Today, with the market getting shellacked, many high growth companies getting hit hard, APPS is down 1 penny. Again, I think there's a lot of support for this stock. I think it goes higher. Ciena, this is in the telecommunications equipment space. Notice it's right down near this low where it was after earnings. So I think this is one you can keep a very tight stop, and another one that still is performing relatively well to its peers. And then the last one I have is Casey, CASY. You can see here that on this particular stock, it is holding its 20-day moving average. It's more defensive. It's in the food products company. So if you pull up a relative chart, you will see down here that among its peers have been coming down, but on a relative basis, Casey continues to push higher. I think relative to the S&P 500, it also is pushing higher. And those are my Monday setups for this week. We will be right back with the latest sentiment readings after this brief message.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have Chart School and creative strategy videos to help you become a better technical trader. leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
All right, it is time for the Decision Point Sentiment Update for August 5th, 2019. I missed it last week, so we'll be seeing, of course, the readings from last week as well as this week. And the sentiment update, I go over these sentiment indicators. We look at the put-call ratio, American Association of Individual Investors, AAII, National Association of Active Investment Managers, or NAME. And this one is really interesting because we get to see the exposure of active investment managers. How are they exposed to the market right now, given what's going on? Right-X ratio, we're going to look at whether the money is flowing between bear, bull funds, and money markets. Wall Street Sentiment Survey, what are market timers thinking for the week? VIX, of course, we have to look at that as if you're talking about sentiment. And then I'm going to cover gold and gold sentiment at the end of the presentation. So I'm not going to give you the summary yet because it is time to look at some of these charts. All right, so we're going to start with the 10-day moving average of the put-call ratio. And you can see, of course, that it is in decline right now. Let's see if I can get my pointer coming back here. All right, well, it'll eventually appear. All right, here we go. So what you can see right now, of course, is the negative divergence on the double top of what we saw as far as price, and also what we saw as far as the indicators. You've got those in decline, yet you've got those price tops rising, so that's a negative divergence. The fact that we are starting to see the movement move to the downside on both of these indicators that I have shown here, that means that we should expect more downside. Although, I mean, I have to admit that we are seeing we're seeing that it's coming into, especially when you look at the equity put call ratio, we are starting to reach what you could call oversold territory under normal environment circumstances, but there's certainly room for it to move lower. And at this point, you know, the OEX put call ratio, it's a little bit, it travels almost opposite the others. And that's really because a lot of people have told me that the OEX put calls are typically used as hedges. So a lot of times you'll see the opposite movement on those. But I don't like that negative divergence. I think that that is something that we should be concerned about at this point. And I did write about some serious negative divergences going on in the breadth area, and then looking at the you know, the number of stocks above their 20, 50, and 200-day EMAs. So negative divergences are out there and they haven't resolved yet. So keep that in mind. AAII investor sentiment, and this reading comes in on the Thursday of last week. And I find it really interesting that on Thursday, everybody obviously was ready for a move to continue to the upside. Even though we had seen a move to the downside for the week, everybody, I think, was expecting the movement to continue. And interestingly, here's how you can see that sentiment is contrarian. When everybody's a bull, the market tends to go down. And when everybody becomes bearish, that's when you look for the price reversal to the upside. Notice right here, so we had that down week, right? You can see right there on that one area. So we had somewhat of a rise, but you had the down week, and then immediately bulls started to pull back. And typically when you start to see that, then that means the market's going to, you know, make itself up to the upside, which it did. And now we've got more bulls thinking, of course, this has got to be it. we're reaching the low here. It's time to look for the markets to move up. But as far as sentiment goes, I don't like seeing that kind of a rise. But more importantly, look at the contraction of the bears right now. That's a problem as well, because people are getting less and less bearish. They're feeling more bullish. At least, of course, this was as of the reading that was on Thursday. I'll be interested to see what people are thinking this week. If we get a price reversal, they'll probably be pretty bullish, but we'll see. As you can see, the bull-bear ratio, this is the one that really bothers me. That makes a comparison between, of course, how many bulls there are and how many bears. And right now we're seeing that ratio at 1.6. And that is elevated. I mean, when you get to the 2.0 area, that's when you have twice as many bulls as you have bears. That is certainly the danger area, but I'd say this is still a warning area when you see 1.6. That means there's just too many on the bullish side, despite it not being a huge reading when you're looking at only about 38%. But the fact that there are so few bears, that's really what makes this ratio important. And we're seeing that move to the upside on the ratio, and that is bearish for the market. So far, what I'm seeing is that we would see a continuation. All right, the name exposure reading. Again, this is the active money managers. So let's look at their exposure rating right now. So as of Friday, the exposure was 91.41. That is really on the high side. Now, when you look back here, of course, there was this very high reading, and I'll tell you right now that that was historically an all-time high. We had not seen that. And so just being where we're at right now in the low 90s is a problem. That's still a lot of exposure out there. I am expecting, given what's going on and went on last week and is starting to continue, we finished the week in the S&P 500 down over 3%. So it'll be very interesting to see next week whether these readings are moving further to the downside, if we're going to see less exposure. But this is still pretty high exposure, especially when you're looking at a drop of this degree last week. So I still think that this looks bearish. The exposure is still far too high, in my opinion. So I would be, again, looking for a possible continuation. Wall Street Sentiment Survey. On Fridays, I get an email, among other market timers get an email, and we have to tell Mark Young of the Wall Street Sentiment, I should have put his little call card here, wallstreetsentiment.com, and we tell him what we think the market will finish at the following week. Are we bulls, bears, or neutrals? I've been in the bear camp. I continue to be. You can see as far as the ratio, we're still seeing a fairly elevated ratio, 1.42. My thing was looking at 44% are bulls, and I think that's on the higher side given what we're seeing. But again, the main point is this ratio. We're still seeing a lot more bulls than bears, and that is bearish for the market. All right, let's look at some RIDEX asset analysis. Okay, here we go. So this one is made up, so there's a group of static funds that we look at as well as money markets, and it was managed by RIDEX. Now Guggenheim manages all of those funds, but it's a closed universe. So you have the bear funds, you have the money market, and then you have that equal bull and sector funds, so these offset. What we look for is where the cash is actually going. It's one thing for people to take a survey and say, I'm a bull or I'm a bear. It's a completely different thing if you say that, but then your money goes elsewhere. So for example, you do have a lot of bulls as far as that Wall Street Sentiment Survey went. But where is the actual money going? Are we seeing an increase in equities right now? Are we seeing those sorts of activities going on? And that's how we can do that with this RIDEX funds chart. So what I noticed, and you can see it very clearly, is certainly a rise in the bull funds cash flow and assets. Not a surprise necessarily. You are seeing a huge decline here, which of course would move assets up in that class, but still it's quite a degree. We moved ahead of these previous tops. We're not really at the high we could see. We could certainly see more action going into these bear funds. And, we lost some as far as the money markets go, but when I looked at this, it's almost even, but we did overall come from, back here at 400 and we've moved lower. So we did technically see money moving out of the money markets. And then you can see really that as far as equities goes, we also saw a decline. So big decline here on the assets. A lot of it, like I said, due to, the actual decline of the market. That's going to bring how many assets are in that sector, bull and sector funds down somewhat. But overall, we did see a decline. On Friday, we did get a little bit of a move to the upside with money starting to move back into the equity funds. But overall, what I see is a lot of bearishness. People are leaving equities. They're even leaving cash to go ahead and short and move onto that bearish side. So when I looked at this, I was looking at it as being mostly, I said neutral to bullish, because again, I still think that we could see more action and a higher amount of assets move into the bear funds before we get the turnaround. So I still think that this, typically this is bullish when you start seeing action moving into those bear funds. But I'm going to say neutral to bullish, just because I think that we could still see some move to the upside there. But I'd rather stick to neutral and then follow through with what sentiment tells me to do, which is it is contrarian. All right, we'll look real quickly here at the VIX. And this is really the interesting chart. So when we first had this penetration back here of that lower Bollinger Band, because this is sentiment, I flip my VIX so that the higher readings are on the bottom, because the more nervous and scared people get, that means they're more bearish. And that's typically when you're going to see that move to the upside. And you can see a lot of indications where that has happened. I look at this action on the VIX as similar to what happened with the May decline. And, you got those penetrations below that Bollinger Band, but even when it came in and managed to get back up, it was only a short relief rally. That's what I am afraid we're going to see. We'll end up with a relief rally, but it won't, it'll probably get stuck here. This is the ETF, the SPY. I think it would get stuck around 295. Your breadth, though, and the fact that the VIX is even higher, we're getting really close, I would say, to a selling exhaustion. But at this point, I still think we could see a little bit more downside. But I think there is some positivity in that as far as volume goes, the net advanced decline volume, we're starting to see pull back a little bit here from that negative. So in the shorter term, I think we will see some decline, but we probably will see a little bit of relief maybe into the end of the week. Unfortunately, though, I just don't think it'll be enough to hold up a rally. And here is GLD. I wanted to use a GLD instead of dollar gold because I wanted you to see what's happening today as far as that breakout. And I already went through the price chart and Monday setups because I do like gold. I still think we're going to continue to rise. PMO is about ready for a buy signal here. I think there's still some more movement to the upside. And again, noticing that correlation between gold and the dollar, we're kind of midway, just a little bit higher. So I think that, actually is a good thing for gold, that it isn't going to be necessarily tied to the dollar. And I think that is because we're just getting a lot of interest there and a lot of movement to the upside. All right, so that is the conclusion here. So let's go ahead and see what the match is as we go through. I will put these, I would say that right now you want to look for bearish, 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 neutral to bearish as far as that sentiment survey. Overall, it's not looking that great. The only ones that I thought were looking good, neutral to bullish for the RIDEX ratio. I think bullish short term, I think we still have a little bit more decline, but I think we're looking at a possible selling exhaustion lining up here. Discounts have been elevated. And, at this point, we got that price breakout on gold. So I am bullish on gold right now. And that is your DP sentiment update for now. So I don't know, Tom, I'm thinking that, with the VIX getting to those high, getting to the high side like that, we're probably looking at an exhaustion lining up.
Yeah, I think I think you're right. I think we'll probably get a bounce. And I think we'll probably go down one more time. I think that that's kind of a typical ABC kind of correction.
Hmm.
I think the VIX will probably give us some signs as to how far we go down on this initial move. That May move that you saw, I don't think we ever closed. I think we had one close above 20. Right now, the VIX is at 2287. So unless we get a reversal today, I suspect we'll continue moving lower in the short term. Put call ratio definitely beginning to move. I know I follow the 5-day moving average of that equity only put call ratio, and it's getting to a point where we will probably see a reversal fairly soon. But as I mentioned earlier, if you're off by a day or two of calling a bottom, it can be really painful. So
Exactly.
I think you just got to be really cautious right now in the market.
Absolutely. And there was a question, Erin, should we be long, short, or in a money market? At this point, I'm holding up in neutral. I'm still holding my what I have because I'm going to kind of bank on that little rally, and that's when I think I might take myself out, move mostly into cash. But a lot of my positions right now are defensive, so I'm not going to really be dipping out of those for a little while.
Yeah, I remain very bullish the market, but I'm cautious near term. I mean, stock market's going to have corrections from time to time. Doesn't mean that it's starting a bear market. I think that's, when the panic kicks in and we start seeing these big sell-offs like we've seen the last few days, that's the first thing that goes through everybody's mind is, oh my gosh, have we reached that top? I mean, are we going to go down for the next 2 years? I don't think it's anything like that, but I would not be shocked if we went back, and we had a poll last week about, how far maybe the S&P 500 goes to the downside. And I think there was quite a few people that thought we might get that 10% correction and move back down close to some earlier lows. And I would not be surprised if we went back down there. I don't think we'll go down there, but I wouldn't be shocked if we did. I think you better be prepared if that's the case. And let's not forget, August and September, not a great time of the year.
Absolutely. Absolutely.
So a lot of history there.
All right, so I am going to be putting your 10 and 10. I obviously was doing sentiment, so I'm not going to have the RRG, but that's what I'm getting to do right now. I'm going to be putting in these symbols and giving Tom them, but go ahead and vote in the chat room. The most popular will be the second symbol.
All right, well, let's get this started. Yeti Holdings. I put a lot on this chart. You can see the recent lows. I think that if the market continues to be weak, I wouldn't be shocked to see it down 22, 23, close to 24. This company just 2 or 3 days ago beat top line, beat bottom line, raised estimates, and since then the stock has been down probably close to 20%. Doesn't make any sense, and the market doesn't make sense when volatility picks up and we start seeing sell-off. This could be a great opportunity down the road. I'm not sure I'm ready to call it right now. Big reversal later today in the market with this stock closing back above its 50-day. I think I'd take, might be willing to take a shot on it with a stop below today's low. Because if it goes back down below today's low, I think there's a decent chance we're going to go back down and test these earlier lows on Yeti.
All right, and the most popular in the chat room currently is SH.
All right. Well, that is the ProShares short S&P. It's hard to. Well, this isn't a juiced ETF, so we can use the chart. But I think again, you talk about the low that we saw back in June in the market. That's the top on the SH. So if we were to get that 10% correction, that is certainly possible. I mean, I can't say that we're not going to get that. I think that you've got a couple of key areas right in here at about 2850 to 2865, which is where we could get to. If that's what you're looking for, that's where I would take profits on the SH.
All right, next one up I have for you is MAG Silver Corp, MAG.
All right, MAG. Well, I know that on a relative basis, materials were doing a little bit better today. MAG Silver Corp, you can see the stock trying to get a breakout. We got a nice uptrend in play. Nice volume trends. I don't really see too much bad here. I think what I would simply say is, we got a breakout above that triple top. So right in here, you can kind of see, well, we didn't quite get there here, but over here, see that shooting star, another failure here. And then we got the breakout. Volume was there. Came back down, failed to hold the breakout level, but nice reversal at the 20-day moving average, which I like to see. So I think right now it's trapped between the low here at $11 and the next breakout, which would be 12.25.
Okay, next one up, a favorite of yours, I know, Starbucks.
Yeah, definitely a favorite for sure. Still a great stock. You know, the overall market again is going to take its toll on just about everything out there. You've got the 20-day test coming up. You've got gap support. I would be using this weakness as an opportunity to pick up relative strength winners. And so I think as the sell-off continues and Starbucks moves closer and closer to its 20-day moving average and gap support, I think that is all right. I'm not sure. Whoops. There we go. I'm not sure, if we get down there or not. But as we get closer, I think the reward to risk really picks up here on Starbucks. I like it.
All right. Next one I have is PYX, Pyxis, consumer staple.
All right, PYX. Well, just being in the consumer staple area helps. Unfortunately, this has not been a very good performer on a relative basis, as you can see here. So, if I was going to try to hedge and get involved in some of the better consumer staples or utilities or real estate names, I think it's pretty easy to see that this is not one of those. And again, not only are we seeing it move down on a absolute basis, but we're also seeing it across the board. That was its industry group. There it is relative to its industry group, relative to the S&P, and look at its industry group going down. So I'm not seeing any hope here for this one. I don't like it. I'd look elsewhere. Even if I wanted to be conservative, I think there are other conservative plays that are a lot better, including some of the ones Erin showed in her Monday setup.
All right. The next one, and I do still own this one, although it's software, AYX.
I own it as well. That's the second stock I have in my trading account.
Oh, well, there you go.
Yeah, the gap support is what I'm watching. Close below that gap support, and I'm out. So I'm keeping a pretty tight stop here because of the overall market. But like the APPS I showed earlier, you got a real relative winner here. So that's the support level I'm watching. See, we got right down to it, and buyers came back in, which I like. But this is, the part that you just can't ignore. I mean, if you're going to be in stocks, especially aggressive stocks, you want the relative strength to continue to hang in there. You don't want to start underperforming because the market's getting hit. So if you're underperforming, obviously you're getting hit very, very hard. So I think AYX looks good. And like I said, I own it. I've got a tight leash on it, but I do own it right now.
All right. Yeah, I'm in it for the longer term. So I'll be holding it probably unless it gets down to that 110 area. I think that would be my scare point. Let's see. Next one up, Ciena, CIEN.
Yeah, I covered that one in my Monday setup, but this is clearly the area that the stock's got to hold. So I would just simply reinforce. I mean, after the huge gap up, you can see here we had a prior top, we gapped up, and then after gapping up, of course, you got market makers on the short side. We did see that move down initially, but look at the recovery, very, very bullish candle. And each time we come down and test this level, this is where we bounce. So I'm not a huge fan of initiating positions, but like I said earlier, if I can get one that's very close to a key support level, I could take a shot, but I would do it with fewer shares because what happens if you wake up tomorrow morning to another 400-point down open on the Dow and the stock gap's down $2? Nothing to guarantee us that doesn't happen. So I think you just have to be a little safer with your positions. If you take a position, just make sure it's a fairly small one, or at least smaller than normal, until the market settles down.
All right, and here is another one in the this one's in semiconductors, and maybe this is reaching that support level to pick it up. CRUS.
All right. Well, anything in the semis is obviously a problem, but this is one of the leaders, and you can see the huge move up last week on a relative basis, not just to the S&P, but to its peers. And I do think that this is one that's kind of like Teradyne. I mean, it's in a group that you've got to be careful with because of the tariffs and the way this area of the market can be hit because of that. But I think this is your support zone right in here. Gap support at the bottom of the gap, 49. Top of the gap, probably about 51.5. Today's low, 52.10. This was a stock just 2 days ago, 60. So as it comes back down, I think the reward to risk gets better. But it is in that group that can be really hit hard with the tariff talk. So I like it, but maybe just a little bit higher risk than normal right now.
Right. This is a software company not looking quite as good as AYX, Twilio, TWLO.
Yeah, this is one that's taken a tumble here of late. I've seen a number of these stocks starting to show relative weakness, and I agree. Twilio is one that has rolled over and on a relative basis is bothering me. I mean, there was a multi-month, 6-month relative low, and we are threatening breaking down. And it's not just that, it's also the volume that's coming in here. All of a sudden, I'm seeing what appears to be distribution. It's losing relative strength. I would say this final straw for me is this price support that we have been enjoying for the last 5 or 6 months. If we don't hold, if we close below 120, I'd be out of Twilio.
All right. And let's see, our final is ACAD, Acadia Pharmaceuticals Biotech.
All right. Well, that certainly hasn't been a very good area of the market. But this has been a good stock. After gapping down, it's come roaring back, potentially putting in a high. I think it's established a trading range, but relative to the biotechs, this has been a pretty good performer here. But there was the low on heavy volume. Here was the high on heavy volume. I think a close above 29, and we're almost there. Close above 29, I think would be very bullish, especially if the volume picks up to the downside. And this is a pretty wide range. It's been very volatile the last couple of weeks, but I would be looking all the way down to 22 if you wanted to look for something maybe just a little closer in terms of support. It would probably be with such a big move recently, maybe that rising 20-day moving average right there. But you are in a very uncertain space in the biotechs, but fortunately, at least recently, you do have one of the relative leaders.
All right, and that does complete the 10 and 10. Here are those symbols that Tom just annotated. And it is time for our poll and seeing what everybody thinks about the trade wars. So I'm pretty interested in finding that out. Here we go. A lot of people in the no side. What did you say, Tom?
Well, I didn't physically vote, but I would say no as well. I mean, come on, they just can't come to an agreement. I'm just going to be surprised positively one day if there's an announcement. Until it happens, I'm going to assume it's not going to happen. I mean,
Right. Well, I have my own theories about it. I said no. And, the main reason I said no is that, and I think a lot of people are talking about this, China can take a hit for a really long time if they have to. They're taking the hit. But you know what? To them, it's worth it. I think they're waiting for the election. I think they're hoping against hope that Trump doesn't win. And they're going to hold out. They're just going to hold out. If he does, that'll be when it's going to get interesting. But I think for now, until the elections in 2020, I don't see anything happening with it.
Yeah, I don't want to get into, political discussion, but I know that there have been a lot of Democrats that actually have supported our position on trade with China because China has taken advantage of a lot of areas of the trade deal over many, many years. And so I'm not sure whether the election would have a difference or not longer term. I mean, I guess we all could speculate on that.
Mm-hmm.
I don't know. I feel like the markets have voted for the past year and a half, and there's been a lot of talk about the trade war. And it seems like at least the money is saying that the U.S. will win this war eventually.
Oh, I think so. I think that they're going to hold out as long as possible to get rid of President Trump. But I'm not stating any political. That's just, basically that's their whole thing. They are a social, communist country, and their political ideal is really what leads them.
Mm-hmm. Well, it will be interesting to see. I don't know. I know that this just continues to surface and then it kind of dies off for a little bit, then it surfaces again, and every time it surfaces, seems to be right about the time the Fed does its thing. So they're like, 1-2 punching everybody, with both. But anyhow, we'll see.
Mm-hmm.
All right, it is time to wrap the show up again. I want to thank everybody for being with us today. Please remember to complete the survey as you exit. It is located below the video player. As a quick reminder, Market Watchers live airs 5 days a week, Mondays through Fridays from noon to 1 p.m. Eastern Standard Time. Have a great afternoon, everybody. Be safe out there. Got to be careful in this kind of environment. We'll see you back here tomorrow. Happy trading.